Somebody profound somewhere once said that there are two things inevitable in life: death and taxes. And according to official statistics, the UK is in the top 10 most heavily taxed countries in Europe. And as a banker, someone who's worked in finance all of his life in credit risk and other areas of banking, when it comes to taxes, it's really important to get this right, because your wealth and your income is always going to be net of taxes. So what we want to do is minimize that legally as much as possible. So today I'm going to tell you exactly how to pay less property tax in the UK legally. I'm going to ask questions like, should you invest via a limited company or should you invest in property via your personal name? Because what you choose will determine how much tax on property you pay in the UK. And ultimately, it'll be the difference between taking home tens of thousands of pounds that you're entitled to versus giving it away to the government when you actually don't need to. So as you can see on screen now, tax is defined as an amount of money that government requires people to pay according to their income. And the key part of that is the income, okay? The income, because when it comes to how to pay less tax in the UK, there's only one real way to minimize the amount of tax you pay, and that's how your income is assessed by HMRC. For the sake of calculating tax for accounting purposes, the goal is to make that number, that income amount, as small as possible legally, so that you pay as less tax as possible. So let's not waste any time and get straight into examples of how to do this. So first of all, here are the current income tax bands. I'm really going to focus on the basic rate and the higher rate tax bands, because most people in the UK fall into one of either of these. You'll be charged at the basic rate of tax in the UK if you earn between £12,571 and £50,270. The average income in the UK is actually £34,000, so most people are going to fall in the basic rate. If you're lucky enough to earn above £50,271 all the way up to £125,140, you're going to be charged at the higher rate of tax. So those are the tax bands that we're focusing on today. So how to pay less property tax in the UK really depends on what tax band you're in, and let's do them one by one in order. So let's start off with the standard rate 20% income tax band that the vast majority of people in the UK are in. So let's assume that you're getting, I don't know, £2,000 per month from a property that you own, a buy-to-let property. So that works out to £24,000 per year from your rental income from property. Let's say that your letting agent fees are 10% of that per month, so £200. That works out to £2,400 per year. Let's say that insurance on the property you own is £50 a month. That's about right, £600 per year. And let's say that your repairs are £200 per month over the course of the year, so £2,400 per year. And let's say that your mortgage interest is £1,250, so that's £15,000 per year. So essentially, this is your income, £24,000, and these are all of your costs. Now, you will notice that your taxable income, this is the amount. Remember, I talked about income is a key amount when it comes to calculating how much tax you pay on property in the UK. You'll notice that this doesn't include the mortgage interest that you pay, which is a significant cost for every single landlord in the country for the most part, okay? Why is that? Because according to UK law, now you are no longer allowed to deduct the costs of your mortgage interest payments from the amount that your tax is calculated on in the UK. So that isn't a tax deductible expense, right? So you pay, essentially in layman's terms, all you got to understand is that you pay a lot more tax in the UK under the new laws that came in some years ago. So in the UK right now, the amount that tax is calculated on is your rent minus your costs of operating a buy-to-let property, so letting agent fees if you have them, insurance, repairs, but not your mortgage interest payments, okay? I hope you're all with me. So you're going to be charged 20% of this amount, which is £3,720. Now, under the current UK law, when it comes to owning a property and the tax you own, you do get a tax credit. They give you back 20% of the amount of mortgage interest you pay. That's your allowance, okay? That's your allowance. That's a portion of your mortgage interest that you pay per year that they won't tax. 20% of £15,000, which is equal to £3,000. So the net tax you pay is £720, which is £3,720 minus £3,000, your allowance. I hope you're all with me still. So the amount that you take home after all these calculations, after tax has been calculated, is £24,000 minus £2,400 minus £600 minus £2,400 minus £15,000 minus your net tax paid of £720. You're going to take home £2,880 per year in this example if you are a standard rate taxpayer at 20%. Now let's calculate how much you'll be taxed and how much you'll take home if you own exactly the same property with exactly the same costs, but instead you're a 40% higher rate taxpayer. So all the same costs apply. It's exactly the same property. The only difference is that you are taxed at a higher rate. Look what happens to the amount of tax you pay. You're now paying 40% of your taxable income as opposed to 20% before. So the amount of tax that you're paying has doubled. 20% before as a standard rate taxpayer, 40% as a higher rate taxpayer, so £7,440. You get the same tax credit of £3,000, so your net tax paid is equal to £7,440 minus £3,000, resulting in a net tax paid of £4,440. Look how much bigger the property tax you pay is in the UK if you're a higher rate taxpayer compared to if you're a standard rate 20% taxpayer. Just over £3,700 more. Crazy. And what does that mean? It means you actually make a loss on the property that you own of £840 per year. It's not worth owning the property because you're actually making a loss every year. So if we're talking about how to pay less property tax in the UK, you can see from this example on screen that a big question is raised. Should I own a property in my own name if I'm a higher rate taxpayer? As a standard rate taxpayer, as long as the sums and the math work out, you know, in terms of the rental amount being sufficiently over and above your costs of operating the property and your mortgage costs, and there's some, you know, margin in there to make profit, it can be done as an individual owning property in your own name as a standard tax rate payer. If you're a higher rate taxpayer, you could very quickly be making a loss on buy-to-let property and it might not even be worthwhile. But there is a solution, okay? Let's look at the final example whereby you can buy and own property in a limited company and potentially earn more per year than both of those other scenarios. And just a quick stat for you, at this moment in time, round about 75% of landlords in the UK are buying properties via limited companies for this very reason, guys. And just so you're aware, at this moment in time in the UK, small profits, so anything between £0 and £50,000 per year for a limited company, you're taxed at 19%. That's why I'm using 19%. From £50,000 to £250,000, 26.5% at this moment in time. So I'm assuming that most of us are going to be between £0 and £50,000 if we own property in a limited company, so I'm using 19% tax band. So exactly the same costs, exactly the same rent as before. However, the main difference that you can see here is the taxable income. In the other two examples, remember I said that under current UK property tax laws, you cannot deduct mortgage interest from your taxable income. If you own a limited company, you can. So this £3,600 taxable income is a £24,000 minus all of these operating costs, including mortgage interest. So your tax is going to be calculated on this much lower amount of £3,600 as opposed to £18,600. You see the difference there? 19% of £3,600, £684. There is no tax credit. You don't get that if you own property in a limited company. That's only if you own it in your personal name. So your net tax paid is going to be the same. It's £684. So the amount of annual profits that you take home each year is simply equal to your £24,000 rental income for the year, minus all of your property related operating costs, including interest, also minus your tax, which is 19% in this case, £684. Completely different scenario owning property in a limited company compared to your personal name at the different tax bands. And also don't forget, even if you are a lower rate taxpayer at 20%, the more properties you own over time likely to take you into the higher rate tax band, because as your portfolio grows, it's going to increase your income and likely push you into the higher rate tax band eventually. So, big decision to make. Now, you've just seen me do those calculations on screen using Excel. Screenshot those, by the way, replay them because they're really helpful. You could do that. You could build your own Excel to do all of the calculations. You can take the time to do all those calculations manually. I like doing it because I'm a nerd. You don't have to do that. There is a company that I like to use called TaxScouts who do that all for you on an online tool. So you don't have to build an Excel, you don't have to build formulas and sums and put in all of that effort. Take a quick look at this. I'm going to literally do everything that I did in that Excel in a couple of seconds, and it's going to churn out the same numbers with a fraction of the effort. So my annual rental income was £24,000, which is a monthly rental income of £2,000. Let's say I'm in the standard rate tax band, so I'll give myself an annual salary of £25,000 per year. No other income. Let's add expenses. So remember, my mortgage interest was £15,000 per year, so that's £1,250 per month. And my other monthly rental expenses were my letting agent fees, my insurance, and my repairs, which all added up to £450 per month. And as you can see here, it's basically churned out the same number that I had right here using my spreadsheet, £2,880 per month. So as I said at the beginning, tax can be stressful. It's not the most exciting part of property. It's not the strategies, it's not the refurbs, it's not deciding how to decorate and redesign a property, but it is very, very important when it comes to your wealth and your money in your pocket, when it comes to the short, medium, and long term. And TaxScouts, this online tool, know this, and they've created this all-in-one online tool service to make the whole process as painless and as easy, simple, fast as possible. That's why I use it, guys. If you want to use it too, there is 10% off for new users. I've pinned a link in the description below and also in the comment section below. So if you're watching this and you feel like it's going to be useful for you as a landlord, it also works for self-assessments as well. So if you're not even a landlord, you just want to do your self-assessment, you can use it as well and get 10% off. Check out the link in the description or the comment section below. Guys, I hope you found this useful when it comes to assessing how to pay less tax on your property in the UK. Some tips, some options there, some stuff to think about. Check out TaxScouts, go to the calculator, pick up the phone and speak to a tax advisor as well if you need more help. Hope you found it useful, guys. Thanks as always for supporting. Share this video with somebody that you think may benefit from it, because that's how this channel grows. And I'll see you guys on the next one.